Hi everyone, Jarrett Clay again with IG Wealth Management. Today I was hoping to talk to you about investing for the long term. Obviously, anytime we go through a period in the markets where we go through a sharp downturn, there's lots of angst in people that are trying to invest, and rightly so. They're watching their money, their value go down, and they're worried about what they should be doing. And what we often are saying and what we want to be able to back up is we want to invest for the long term, okay? The reason we focus on this is because we know that whenever you see a downturn in the markets, historically, what you're seeing is an increase in the next 12 months following that negative return. So, as you can see in the sort of graph below, if we go through and take a look, that basically when there's about half a dozen occurrences where we go through sharp downturns, often in periods of time that you can remember in your lifetime, where you're like, oh yeah, I remember the various crises that were occurring at these times, and oh, those downturns were awful. But what we wanted to focus on is like, yes, the downturns are bad, but if you look at what happens post the downturns, look at the recovery that occurs. So even in the first 12 months that follows that negative return, we see normally very high returns, even in the very next year after the event has occurred. All right. So basically, in about five of the six examples, you see that there's a very large positive outcome coming out of that negative downturn. And even more importantly, in my books, when we're talking about long term, is that in the 5 years following that negative return, you get very large absolute returns. So look at the various numbers of how big the absolute return is overall over a 5 year period compared to where you started at the downturn. So basically a 72%, 49%, 168%, 227%, 79%, and 76% absolute returns, which annualize in anywhere from an 8 to about a 12% on normal, including a 22 and a 27% overall return annualized in the 5 years after that downturn. So it's not that we guarantee these outcomes, it's that the best judgment we have often is look at our historical data of what actually occurs when these bad things happen in the market. And generally, it is not bad news for the long term. It actually looks quite positive. So when we're advising that we want people to stay invested and remain invested, it's because we know that the likelihood is that these returns are coming back. We just don't know exactly when or what the timing is. We don't know what the best days in the market will be. No one knows that. But if you are pulled out of the market, by the time you react to a market going up, you're going to miss the regaining that occurs as it goes through. Far better to keep your units. Remember, you own just as many units as you did when everything went down. If you kept all your money in, your units stayed the same. It's just your price for them will have gone well up if you just stick it out for those next 5 years afterwards. And that is really what the gist is to the whole story. All right. Hopefully that makes sense for everyone. You have a great day.